Oaktree co-founder Howard Marks recently sat down with Oaktree senior financial writer Anna Schmansky to discuss assessing risk in today's markets.
So Howard, thank you so much for joining me today.
It's a pleasure to be here, Anna.
The first half of 2022 has been a challenging period, leaving many investors to ask, which way now? I know you're often asked simple buy, sell, risk on, risk off questions. Why do you find such questions so deficient?
I think they're really superficial, and these are important matters. They can rarely be answered simplistically. In order to be confident in giving buy-sell advice, you have to be confident that you know something that the consensus of investors doesn't know. And the more you get away from what I call the micro, companies, industries, and securities, the more you get into the macro of economies, markets, currencies, commodity prices, rates, the less confident you should be that you know something the consensus doesn't. We have to think about the adequacy of today's price in reflecting those things, and there's no place to look that up. So what does it all come down to? Judgment.
So if there are no simple answers, what advice would you give to investors assessing their risk posture today?
My theme for the last half dozen years has been that every investor should think of positioning their portfolios in terms of a speedometer in a car. It goes from 0 to 100. Maybe we should say 0 is all defense, no offense. 100 is all offense, no defense. The first requirement, in my opinion, is that every investor or every manager for each client should have a sense for the appropriate normal risk posture. And clearly it varies from investor to investor, client to client, based on what are their resources, how adequate are their resources relative to their needs, where do they stand in the life cycle of producing inflows to the account relative to the outflows, what are the aspirations, and importantly, what is the ability to withstand volatility? Now we have specified the normal balance, the normal position on the speedometer between aggressiveness and defensiveness. Okay, 2 more questions. Number 1, are you going to maintain that posture all the time and say, you can't time the markets and I'm not going to try? Or will you vary your posture from time to time based on what's going on in the market? No right answer to that, up to each individual. But if the answer to that question is, no, I'd like to try to vary my posture, then the next question is, okay, how today?
And so at this moment, what would you say are some of the trends that should encourage investors to be more or less defensive?
The big story of the last 2 years is the massive Fed stimulus, rate cutting, bond buying, and the government's deficit spending. And these have produced a tsunami of liquidity in the economies and the markets of the world. And they're being cut back now. We're actually in a destimulative direction. The behavior of the Fed over the last couple of years suggests that they will continue to tighten. We know they're going to continue to raise rates out of concern over inflation. And all things being equal, that is less salutary for the markets. Interestingly, 50 years ago, we used to talk about the fact that bonds and stocks diversify, but they're both impacted by changes in rates. And recently, we've seen higher rates and we've seen lower stock and bond prices. But in addition, higher rates tend to reduce economic activity, which means that companies' earnings are lower than they otherwise would have been. And lastly, of course, you don't need me to tell you that we have a very high degree of geopolitical uncertainty and turmoil these days, starting, of course, with the Russian invasion of Ukraine. So those are all the factors that argue for more defense and less offense than what you have concluded is your normal posture.
And would you say there are any trends that suggest that maybe investors shouldn't be so defensive?
Well, the great thing about investing is that there's always a second hand. And on the other hand, there are factors that counter some of the ones I just discussed. Now, most people believe that the Fed actions to get inflation under control will bring about a recession. Some people think this year, some think 23, some think 24. But I believe that even as the Fed raises rates, which they are certain to do, rates will still be among the lowest in history.
Right.
You know, I always talk about the slip I have hanging on the wall of my office, which says the rate on your loan is now 22.25 from 81. But we're not going back there, I don't believe. But still, I think that the Fed will remain biased towards easy money conditions. You know, governments like it too much, and everybody wants growth.
And it's become so much the norm.
It is the norm, and you know, I think that to go back to historic interest rates would be quite a negative shock. You know, for the optimists among us, there's still the hope that inflation will subside, or that some of the factors that have caused the inflation of the last year will prove to be, what's that word? Transitory. We had pent-up demand, so we had an unusual burst of spending at a time when, because the machinery of supply had been shut down, the supply chain faltered.
Right.
and did not keep up with the growth. So more money chasing goods, less goods available, that's certainly the formula for inflation. We've had very strong inflation. We hope that as the supply mechanism starts getting back into a groove, that the demand for goods and the supply of goods will come into a better balance, implying less inflation. And the final question bearing on inflation is inflationary expectations. I know from the 70s that once inflationary expectations become embedded in psychology, they're, number one, they're hard to dispel, and number two, they become self-fulfilling, because people say, I'm going to buy now rather than later because prices are going to go up, so they buy now, which makes its prices go up. This is a chain
Right.
That is very hard to break. The other thing I want to mention that argues against becoming more defensive today is just that it's really hard to get timing right. And you know, if you turn more defensive, at some point in time you're going to have to turn aggressive again to participate in the normal progression of markets. And it's much more important to be in than out.
Yeah, I know, as you said in one of your recent memos, you had people who got out during the early pandemic period
sure.
and then may have never gotten back
Right.
in and then missed a significant increase.
And I really believe, and I've said a million times, Anna, that getting out at the bottom and failing to get in, as you say, is the cardinal sin in investing. Which is worse, to buy high or to sell low? If you buy high, you'll have some regret. There'll be a downward fluctuation. You'll kick yourself for a while. But there is this positive underlying trend, which means that the economy will move up over time and the markets will move up over time. But if you sell at the bottom, fail to get back in, you will miss the recovery and you miss the long-term trend. And you know, we really we really have to take advantage of the long-term trend. That's the main job of the investor, not jumping around from one security to another or getting in and getting out. The main purpose of the investor should be to enjoy the long-term benefits. Any active steps to improve upon returns, that's just embroidery around the edges. But you know, in a recent memo, I guess in Selling Out a few months ago, I quoted Bill Miller, one of the great investors of our time, who said it's time, not timing, that produces great results. And I think that's true.
Well, on that note, I think it's a great place to end. Thank you so much for joining me today.
Thanks for your questions.